This week, the conflict in the Middle East continued to dominate everything, but we did see some positive flashes of light there, although then there were reversals. A ton of volatility happens when there's uncertainty like this, and oil prices were really all over the place. We started the week with oil around $119 a barrel, and then the Strait of Hormuz still essentially closed, but by midweek, things were starting to change when Trump said the conflict was very complete, pretty much. The G7 began coordinating a release of hundreds of millions of barrels from global reserves, and oil pulled back toward the low 90s. But rates followed oil almost tick for tick. We had days where bonds started deep in the red and then recovered, as well as days where the opposite happened. All in all, it was a bad week for mortgage rates. Now, here's the thing. Even with all that noise, the other numbers we got this week was actually supportive of lower rates. In simple terms, the economy is showing real signs of slowing down. CPI, that's for February, that's consumer inflation, came in as expected, and Shelter posted its lowest monthly increase in 5 years. That's that number that we've been waiting to see move. And PCE, the Fed's favorite measure of inflation, also came in close to expectations, though markets didn't really care too much since it is old information, long before these oil prices started moving. And GDP for the fourth quarter was revised lower, weaker than estimates, and durable goods were actually flat and below expectations as well. On the job front, the ADP weekly numbers ticked up slightly, but still very weak. JOLTS, that's job openings and labor turnover, showed more unemployed people than job openings, and the quits rate is near its lowest level since 2014. When people stop quitting, it means they don't feel confident enough to leave. That is not a strong labor market, which really should have helped rates if it wasn't for everything else going on in the world. And then on the housing side, existing home sales came in above estimates, and realtor confidence is at its strongest level in 4 years. Inventory is still tight, and days on market did drop a little, but that's typical this time of year. Home prices are still rising, but that varies a lot depending on where you are in the country. And one thing worth sharing with clients who are on the fence, the income needed to afford the median priced home, I should say, is down almost 6% year over year. So affordability is slowly improving, and we've got strategies to help get people to a payment where they're comfortable. Now, next week, we're going to get weekly job update from ADP, wholesale inflation, jobless claims, and the Fed statement. No rate changes expected, but we will get the summary of economic projections, which will be worth watching. But really, not much matters since all eyes are on Iran. The oil situation obviously is not fully resolved, and the volatility is not over. But there are plenty of things that show we are headed in the right direction for lower rates once the conflict is resolved. I'll see you next Friday.